everyone, welcome to the next installment of Charts in Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX VettaFi. Today, we're going to look at the monthly moving averages for the IB portfolio and the S&P 500. The IB portfolio is an equally weighted portfolio constructed with 5 ETFs that feature a mix of different asset classes, including domestic and international stocks, bonds, real estate, and commodities. For each fund within the portfolio, I compute a moving average of the monthly closing prices over the past 10 months. If the fund closes out the month below the level of its moving average, the position is to sell and hold cash. If it closes out above, the position is to invest. Now that April has ended, we can look at the updated signals for each of the 5 ETFs that make up the IB portfolio. At the end of April, 3 of the 5 ETFs closed below their 10-month moving average. The Vanguard Total Stock Market ETF, VTI, the Vanguard Real Estate ETF, VNQ, and the Invesco DB Commodity Index Tracking Fund, DBC. So the position would be to sell and hold cash for these ETFs, but to remain invested in the Vanguard FTSE All World Excluding US Index Fund, VEU, and the iShares 7 to 10 Year Treasury Bond ETF, IEF. Essentially, sell and hold cash for domestic stocks, real estate, and commodities, and stay invested in international stocks and bonds. For a slightly different view, and to reduce volatility, I've replicated the process but used monthly closes for the past 12 months instead of 10. Again, at the end of April, VTI, VNQ, and DBC are all in a cash position, while VEU and IEF are in an invest position. In this table, and the previous one, we can also see how far each fund is from its moving average. Notice here the Vanguard Real Estate ETF, VNQ, has its variance highlighted in yellow, whereas in the 10-month table, it was red. That's because using the 12-month strategy, it's within 2% of its moving average, so it's relatively close to reversing positions. Here's a quick side-by-side of the two tables to compare the shift in variance between the two strategies. Going from 10 to 12 months, we see VTI and VNQ have moved closer to their moving averages, while VEU, IEF, and DBC have moved further away. Now let's take a look at the broader market. The S&P 500 closed out April with a monthly loss of 0.8%, extending its losing streak to 3 months. But let's examine the market through the lens of moving averages. To reiterate, we're looking at the index's close on the last day of each month, not the index's monthly average of closes, and then calculating a moving average based on the prior 10 months. So if the close from April 30th is above the moving average, then we hold. But if it closes below, then we move to cash. At the end of April, the S&P 500 closed 3.5% below its 10-month moving average, marking its second consecutive cash position, following 16 straight months in an invest position. Here's the same chart, but this time using the strategy with a 12-month simple moving average. At the end of April, the index closed 2.4% below its 12-month moving average, again marking the second consecutive cash position. And finally, our last variation to this strategy uses the 10-month exponential moving average, a slight variant to the simple approach used in the previous two charts, where we mathematically increase the weighting of newer data in the 10-month sequence. At the end of April, the index closed 1.7% below its 10-month exponential moving average, so once again, marking a cash position for a second consecutive month. To summarize, for a second straight month, all 3 approaches remained in a cash position at the end of April. This is the farthest the index has been below each moving average since December of 2022. And the last time all 3 were in cash for 2 straight months was in September and October of 2022, as we were approaching the end of the 2022 bear market. In April, the S&P 500 came close to entering a bear market, but an end-of-the-month rally relieved some of that worry. Can the momentum be sustained? Or are we at the start of a deeper downturn? Only time will tell, but I will continue to watch closely. Now to close out, I want to point out that my S&P 500 illustrations serve as examples, not trading signals. I use this index because of its extensive historical data, but moving averages strategies should be applied to individual investments, not a broad index. Even funds tracking the S&P 500 like SPY may generate different signals due to dividend reinvestment, which my illustrations do not include. That's all for the April Moving Averages update. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.